Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, June 22, 2026. We're Elena and Marcus.
Glad to be here for today's run.
So diving right into today's proprietary updates, there are really 3 or 4 critical themes that you need to be tracking today.
Right. It's a pretty dense deck we're looking at.
It really is. Theme 1 is this sharp collision we're seeing play out in real time. It's a hawkish Federal Reserve repricing slamming right into this sudden disinflationary relief valve in the energy sector.
Yeah, those two forces are just aggressively pushing against each other right now.
Exactly. And then theme 2 is a very severe, highly concentrated sell-off in mega cap technology. We're specifically looking at Alphabet and SpaceX today.
Which is signaling a pretty massive shift in how the market digests these giant AI capital expenditures.
Right. And finally, theme 3 focuses on the institutional plumbing, so to speak. We are tracking a highly fragile, completely unhedged positioning across institutional portfolios right as rate volatility is steadily climbing.
Which is a dangerous combination, honestly.
It is. So let's start with block 1, the macro side. I mean, what is the dominant macro driver from our daily desk data today?
Well, the core driver across all asset classes today is definitely the reverberations of this hawkish shift at the Federal Reserve.
Right, because the consensus has completely shifted.
Yeah, institutional consensus has aggressively revised its call. They are now projecting 75 basis points of hikes in 2026.
Which is just a massive pivot from where we were a few weeks ago.
Out completely. And they are specifically targeting September, October, and December for these hikes.
And we also had Chicago Fed President Austin Goolsbee speaking today, right?
Correct. And he came out explicitly stating that inflation is, his exact quote was going the wrong way.
Going the wrong way.
Yeah, and he specifically pointed to the services sector.
Let's pause on that because services inflation is really the sticky part of the economy. We're not talking about, lumber or shipping containers, things you can just manufacture more of.
No, services inflation is it's wages, it's insurance premiums, rent.
Right. Structural costs that rarely come back down once they're elevated. And I assume the fixed income markets reacted pretty violently to this today.
They did. If we look at the immediate reaction across the curve, the 2-year Treasury yield,
which is our best barometer for short-term policy.
Exactly. The 2-year rose approximately 5 basis points to 4.230%. And then further out, the 10-year yield rose to 4.508%.
And the long end.
The 30-year yield is rapidly approaching that psychological 5% threshold. It's currently sitting at 4.946%.
So the whole curve is shifting.
Yeah, the 10-year, 2-year spread steepened by 28.2 basis points today.
We also need to view this through a global lens because our data deck shows USD JPY pushing higher, up to 161.57.
Right, keeping the yen squarely in intervention territory.
Even despite the Bank of Japan's recent actions, it just proves the gravitational pull of U.S. rates is dominating foreign exchange right now.
Capital flows where it's treated best.
Exactly. But let's step back for a second. I want to apply a first principles approach here for the regular investor listening.
Sure.
If the Fed is threatening to hike rates at the short end, say, over the next few months, why is the 10-year yield rising so aggressively alongside the 2-year? I mean, how does this actually impact you if you're holding long-duration equities?
That's the essential mechanism to grasp today. So when the 10-year yield rises alongside the 2-year, it indicates investors are demanding a higher term premium.
The extra compensation for locking up your money for a decade.
Right. In an environment where inflation is sticky, you want a bigger buffer. And for regular investors holding long-duration equities like high-growth tech stocks, this is a major headwind.
Because long-duration equities are basically bets on cash flows that won't happen for another 5 or 10 years.
Correct. The valuation of a growth stock is calculated by discounting those future cash flows back to present value. When the 10-year yield rises, the discount rate increases. Mathematically, those future earnings are simply worth less today.
So it triggers a compression in valuation multiples.
Yeah, investors just won't pay the same high price for that projected growth.
On that point, we can actually draw a direct line from that rise in the 10-year yield to the massive wave of corporate bond supply hitting the market today, which brings us to sector and equity flows.
Right, because SpaceX is acting as the perfect bridge here between the macro rates and the equity rotation.
Yeah, looking at the price action, it's highly bifurcated today.
Very bifurcated. The S&P 500 pulled back 0.37% to 7,472.79, and the NASDAQ 100 shed 0.19%.
But the Dow actually gained ground.
It did. The Dow outperformed, gaining 0.29%, while the Russell 2000 jumped 0.83%.
And looking at our latest run, the equal weight S&P 500 remained completely stable today, which proves this isn't a broad market collapse.
No, it's a very concentrated mega-cap tech drag.
So let's talk about the specific corporate movers. What happened with SpaceX?
Well, SpaceX, under the ticker SPCX, plunged 16.4% today to $154.60.
That is a brutal move for a mega cap.
It is. And the catalyst is their inaugural $20 billion investment-grade bond offering. Equity holders view this massive debt issuance as highly dilutive.
I think of this SpaceX bond issuance like a massive sponge dropped into a bucket of market liquidity.
That's a good way to picture it.
It absorbs so much capital that it literally forces portfolio managers to sell other assets just to make room for it. It creates this localized drought in tech equities.
Exactly. And beyond just absorbing liquidity, it's a signal. The market is seeing this $20 billion raise as a sign of aggressive, costly capital deployment for AI infrastructure.
Right. The CapEx fatigue is setting in.
It really is. And it wasn't just SpaceX. Alphabet, ticker GOOGL, dropped 5.0% to $349.68.
Yeah, today's proprietary updates highlight some internal intelligence there. We're seeing senior DeepMind researchers departing to rivals like Anthropic and OpenAI.
Which is a huge loss of human capital.
And you compound that with the competitive threats from Chinese open source models.
Yeah, the premium valuation on Alphabet starts looking very vulnerable. We saw a similar dynamic with Meta today, ticker Meta.
They face selling pressure as well.
Yeah, on reports of computing capacity overbuilds. The market is just rethinking the return on investment for all these massive AI server farms.
Though it wasn't all red in tech, Micron, ticker MU, entirely defied the tech cycle.
Right, surging 6.8% ahead of Wednesday's earnings.
And that's due to a new strategic agreement with Anthropic. So capital is still flowing, but it's rotating down the AI supply chain into semiconductors.
While at the same time, we saw weakness in high beta consumer and restaurant names today.
Like CAVA, Sweetgreen under SG, Shake Shack under SHA, and Domino's Pizza under DPZ.
Right. And if we look at flows and positioning right now, the setup is highly fragile. Wall Street is sitting at its least hedged position in over a year.
That's a bold claim. What's the data behind that?
Our daily desk data shows the SPY 91.1 implied volatility ratio is at multi-year lows.
Meaning downside protection is historically cheap because nobody feels the need to buy it.
Exactly. Meanwhile, the VIX has ticked higher to 17.28. And dealer desks are noting that gross and net exposure to the Magnificent Seven has fallen to one-year lows.
Moving to today's data, we have to pivot from that technology pressure to the commodities complex because we're seeing some sudden, unexpected margin relief for industrials and consumers.
We really are. The oil collapse today was significant. WTI crude tumbled 1.79% to $75.19 per barrel.
And Brent crude fell 2.77% to $78.15.
So what's the specific geopolitical driver in today's data deck causing that?
The U.S. just issued a 60-day oil sanctions waiver for Iran, and this is happening amidst peace talks in Switzerland, which officials are describing as highly constructive.
Which acts as an immediate disinflationary tailwind.
Right. It's structural supply relief, millions of barrels potentially hitting the spot market.
And we saw parallel moves in precious metals. Gold declined 1.04% to $4,179.90 per ounce.
Is that just the geopolitical risk premium unwinding?
It's a dual function move. It's the systematic unwinding of the Middle East risk premium, yes, but it's also a reflection of underlying dollar strength.
Even with the DXY flat today?
Yeah, it was flat at 100.996, but it's fundamentally buoyed by those Fed hike expectations we talked about.
Understood. But let me challenge the narrative here for a second. If crude oil is dropping rapidly, which effectively hands the consumer a disinflationary tax cut, why is the Federal Reserve still aggressively signaling 75 basis points in rate hikes?
It feels contradictory.
Right. Aren't these two data points directly contradicting each other?
Well, the Fed differentiates between volatile headline energy prices and sticky, persistent services inflation.
Going back to Goolsby's comments.
Correct. The 60-day oil waiver drops headline inflation, but it doesn't lower your rent or your medical bills. That persistent services inflation is what's forcing the Fed's hand.
Indeed. Which brings us perfectly to the synthesis of all this. How do we connect the dots across these massive cross-asset moves?
The market is essentially trying to price in a hawkish soft landing.
Okay, let's break that down.
Well, the drop in energy costs gives immediate margin relief for domestic cyclicals and small caps.
Which perfectly explains why the Russell 2000 outperformed today.
Correct. But simultaneously, the hawkish Fed repricing and rising rate volatility are aggressively compressing multiples for long-duration mega-cap tech assets.
So the core takeaway for you listening is that the era of easy money in long-duration growth assets appears to be over for this cycle.
It really does. The underlying market setup is asymmetrical and highly dangerous right now.
Exceptionally low hedges, very high equity valuations, and a Federal Reserve reaction function that is rapidly changing.
There's virtually no cushion if something goes wrong.
Which leads to a final, forward-looking consideration you should mull over tonight. Consider the binary optionality in the energy market right now.
Regarding the waiver.
Exactly. If this 60-day U.S.-Iran oil waiver expires without a permanent peace deal, the market is going to simultaneously face a resurrected energy supply shock and a Federal Reserve that has already committed to 75 basis points of rate hikes.
Yeah, that scenario leaves absolutely zero buffer for risk assets.
None at all. So let's just do a rapid 30-second recap of the core takeaways before we wrap.
Sure. Main things to watch. The Fed's hawkish rate repricing targeting 75 basis points, the severe single stock rotation out of mega cap tech due to AI capital expenditure fatigue, and that geopolitical relief valve actively pushing crude oil lower.
Thank you for listening to Market Pulse by Orestes Capital, where Elena and Marcus will be back tomorrow with the latest market color.